Hi there. Let's study chapter 9. Chapter 9 is titled Accounting for Receivables. And in this chapter, we will have a look at accounting for accounts receivable as well as notes receivable. Okay. To begin this chapter, let me introduce my friend Sean. You may remember Sean from chapter 6. He is selling iPhone cases. He's an artist and he makes orders of his own design iPhone cases to a Chinese manufacturer. When the iPhone cases are shipped, he sells the iPhone cases in New York City, various places. And he also has some business partners, like last I heard that he is selling his iPhone cases to like Verizon shops, so that the Verizon shops can sell his iPhone cases to their customers. Okay, so 1 year, say 2021, he sold here's an example. $100,000 value of iPhone cases. And one of them is actually his sales. A service provider called, say, Nice. Nice cell phone, which values $1,000, let's say. Okay, then what would be my friend Sean's journal entry for these sales? It should be cash, $1,000, and sales, $1,000, right? But let's say that Nice sales, Nice cell phone says that, oh, we don't have much cash, so can he use our credit to you, saying accounts receivable? Okay, my friend Sean says yes, and then it's the deal. Say that it's the date as of December 31st of 21. Again, as we've studied, accounts receivables are expected to be collected fairly quick, maybe hopefully in a few days, 2 weeks, but not much more than 1 month, you know. But it turned out to be that the Nice cell phone was not much nice. They promised that they will return back the cash of $1,000 in a few days, but it's 1 month passed, 2 months passed, 3 months passed, which is pretty annoying. My friend Sean does his best to collect the money, calling the Nice cell phone and sending emails and physically contacting the office, but not much successful. Now, say it is May 1st of 22 next year. Then what does he do? He thinks that, oh my gosh, I am sick and tired of making efforts to collect that $1,000. I don't like it. And my friend Sean says that, let's forget about it. Then what is a way of reversing this transaction? My friend Sean may flip, right? Sales being debited and accounts receivable. Maybe I should make it clear that the accounts receivable is for Nice. $1,000, $1,000. And then accounts receivable being credited, sales being debited, right? Again, sales being debited and accounts receivables to nice being credited, right? Doing this, he can permanently erase the accounts receivable of nice and then reduce the sales, right? Or another way of what's important, do you think? What's important is reporting the net income, right? Which is sales minus cost, sales minus expense, right? So my friend Sean thinks that, no, I don't want to reduce the sales directly. Rather, I will just expense it. Does that make sense? Called bad debt expense. What does that mean? He is thinking that sales is $1,000, expense is $1,000. In the end, I'm going to report 0 for this transaction, 0 net income for this transaction, which makes sense, right? So he decides to journalize entries like this. Here, not good. Here is a really big problem. Can you see that? We've discussed it in chapter 3, I think, and several times afterward. It's a big violation of a important accounting principle. You remember that? It's a violation of so-called matching principle. Or another name of it is expense which states that expense recognition should be matched in terms of timing to the recognition. Oh, I have written it strange. Expense recognition should be matched to the recognition of related sales in terms of timing. What you see here is the timing of sales is as of December 31st to 21, meaning in the fiscal year of 21, but the timing of related expense, right? The timing of related expenses May 1st of 22, which is Sean's 2022 fiscal year, right? As a result, he may end up reporting in the income statement of 2021 the sales of $1,000 from nice, but in the income statement of 2021, 2022, he may end up reporting no sales from nice, but added expense from nice of $1,000. Then investors may think that at the end of 2021, Sean is making sales this much. And then investors think that, oh, the business is booming up, right? We need to make more investment for Sean and the like, right? Or the banks may think that, oh, we can lend more money to Sean, right? But 1 year later, Sean is saying to the investors, oh, guys, I'm planning to cancel the sales. Then definitely investors will not be happy. So this is not an allowed method in the US under the GAAP. And this method is called, actually it has a name, direct write-off method. And again, this method is not allowed. Then, what is the allowed method? The allowed method is called allowance method. Under the allowance method, what was the setting? Maybe it would be better for me to write down both of the allowance method and the direct write-off method in one screen so that you can make a good comparison. Okay, the assumption was in December 31st, Sean recognizes accounts receivable and sales from NICE of $1,000 and $1,000. It applies the same on the allowance. Accounts receivable from NICE and sales of $1,000 and $1,000. Okay, cool. But as we have written off under the direct write-off method at a much later time, when was it? May 1st, okay. That expense and accounts receivable of NICE, much later time, it became a violation of the important accounting principle. Meaning, if we want to follow the matching principle, we need to recognize this bad expense at the same time as when we recognize the sales, right? So under the allowance method, we should recognize the bad debt expense. Okay, and instead of directly writing off NICE, which makes sense, right? As of December 31st of 21st, we have little idea whether the NICE is gonna be a rotten apple or not, right? So we have little idea of which account receivable, whose account receivable account we should write off. So we should make a good guess. So what was the setting? The setting was Sean's overall sales over the past year was 100,000, which includes the sales to NICE 1,000, right? So going back to the second page. So this is part of the, how much? $100,000, right? So here, let's make sure that it's 100,000, not 1,000. Okay. Okay. So again, Sean does not have any idea at the time when he makes the deal with Nice for the accounts receivable that Nice will become a villain or not, right? So he should make a good guess based on his total sales of $100,000 for the year, how much is gonna go bad, right? Only that way he can recognize the expense together with the related sales. And let's say that in this example, he estimates that, oh, let's have a look at my previous data. And then Sean thinks that, oh, my previous data shows that about 10% of my customers in the end didn't pay cash. Okay, 10%. Cool. Then maybe I should set aside money of 10% of 100, which is 10K, right? And then set aside money rather than directly writing off the accounts receivable of individual customers for no reason, right? I'm making a guess. I cannot label some random individuals as my customers as bad guys. No, it's not fair, right? So instead of directly writing off customers' accounts, he decides to create a cookie jar, calling the cookie jar as allowance. This is a cookie jar that he will use. This is the cookie jar that he will pull out some of the cookies from when he becomes hungry. Like when a customer turned out to be a rotten apple. Like the situation in May 1st. Again, my friend Sean realized that beginning from January of 2022, Nice is not so much nice, not paying the cash. So he visits the Nice's office several times. They are not responding. They are not paying cash. So as of May 1st, Sean decides to write it off. Now he's hungry. It's the right time to use his cookie jar, which is named allowance. Again, allowance was initially credited, meaning its normal balance is credit side. Now he's going to use it, meaning reduce allowance. Then it should be debited. Which is 1,000. And he knows that now specifically it's Nice whose accounts receivable he should write off. Okay, so as of this date, he has allowance account 10K, but in this date, now he has 10K, 1K, which is 9K. As he ate 1K amount of 1,000 amount of cookie, right, allowance, how much amount of cookie is left in his jar? $9,000 value of amount of cookies left. Okay, that's the way that my friend Sean decides to weather out his hunger, right, as of May 1st. Okay, I'm fine with it. I can live without a nice cash. That's what he thinks. But suddenly, which is a pleasant surprise, suddenly he got a contact from Nice. My friend Sean's initial response was harsh. What's up, you know? But Nice says, calm down, man. I brought you money. What a pleasant surprise. Now, Nice is not anymore not nice. Nice became nice, right? So the first step Sean should do is reinstating Nice name. Nice became nice. So let's reinstate and reverse back our use of cookie jar, right? What we did is just reinstating or reversing this journal entry. And then let's finally journalize the cash receipt. Okay, and what happens here in your allowance account? 10K, 1K are the journal entries, but we have extra 1K, right? On the credit side, meaning our ending balance becomes 10K. Okay, let's recap what we've studied. Again, in the direct write-off method, which is not allowed in the US, we recognized sales and related expense at a different point in time, which becomes not so good. But on the allowance method, we recognize sales and related expense at the same time. Cool. And as a result, we end up using a cookie jar, which is named allowance. And then when the bad weather comes, we use the cookie jar, which is named allowance. So allowance being debited, the specific accounts receivable being credited. But when there is a pleasant surprise, you reverse it back, you reinstate the nice name, and then finally journalize the cash increase. Okay, that's the end of this topic, but one final note. What did I say? To recognize the sales and expense at the same time, we made an estimate, right? What do you think if the estimate changes? And the estimate is based on the company's own historical report, right? Or company's own judgment. Again, your expense, one of the important factors that affects your bottom line, which is net income, is based on company's subjective judgment. Okay. We will see as time goes by this kind of factors that are subject to company's judgments little by little. One of the lessons from this video is net income may not be the profitability that reflects the true value of company's earnings. As, again, net income is subject to some level of management's decisions, which can be sometimes discretionary. Okay. All right, in the next video, let's see ways of estimating this amount of bad debt expense and allowances. Okay, see you there.